Welcome to the Vaughan Nelson podcast. Today is the second quarter 2026 Vaughan Nelson Small Cap Value Recap. And with me today is Ben Carrier. And with that, Ben, we will turn things over to you.
Thanks, Dan. It was an exciting second quarter in the financial markets. The small cap strategy had sector performance contributors of consumer discretionary, materials, and energy. It had sector detractors of technology, industrials, a little bit of cash drag, and some financials. It was an active quarter for the strategy in terms of buying and selling positions as the market experienced heightened volatility from the AI boom that's continuing and the war with Iran that drove a lot of energy volatility and equity market volatility as well. As a result, the strategy initiated 16 new positions and sold out of 18 positions throughout the time of the quarter. The main rationale for the sells were a combination of size issues due to cap getting too large, some rate sensitivity due to higher inflation expectations from higher oil, and due to some stocks simply reaching their valuation target from longer duration holdings. I want to talk a little bit about a broader theme that we've seen exacerbated, particularly in the last quarter, but also over the last 12 months. And that is the divergence in equity price performance of unprofitable and profitable small cap companies. There's a chart that anyone can find that Bloomberg has an index of the Russell 2000 broken out into separate indexes of unprofitable and profitable companies. And you can see over the last 12 or so months that the profitable companies have returned roughly 30% as a basket, and the unprofitable companies have returned close to 60% as a basket. I mean, the gap in performance here is absolutely staggering. What's interesting about the most recent quarter is that gap was starting to narrow in late February and early March. And then it started to massively accelerate as it became pretty obvious to the market that the events in Iran were not going to be short lived. This wasn't going to be a Venezuelan type event. We were going to have to be there for a while. The implications of the energy price spike and the battle over the Strait of Hormuz were going to take a lot longer to resolve than previous foreign actions by the U.S. government. So, what did this mean practically? Well, energy prices were going to be a lot higher. They spiked very, very high, very, very quickly. Logistics became very, very complicated. Supply chains got more and more difficult to navigate. And smaller cap companies historically don't have the resources of large cap companies to navigate that sort of stuff. Also, shipping costs, if you look at shipping equities, went through the moon, indicating massively higher increases in costs to move products around the world. None of this at a high level really supports the fundamentals of a lot of unprofitable small cap companies. You would think intuitively that their ability to generate cash flow in this type of environment would be somewhat impaired, not helped, and yet their stocks went up anyways. So, what does that tell us? Well, that tells us that a lot of the recent price action is being driven by non fundamental factors, whether that be short covering rallies due to outsized exposures at hedge funds using leverage. It could be, index levered ETF buying. It could be a lot of factors. But what we are confident of is that it's really not fundamentally driven because a lot of the fundamentals I just described don't help unprofitable small cap companies. If anything, they actually really hurt them over the long run. So, what is the strategy doing as a result of this? Well, as I mentioned earlier, we bought 16 new positions and sold 18. The 16 new positions that we initiated, we think are companies that are at very attractive valuation levels. They're deploying capital, we think, in a very accretive way, or they're within industries that we think are experiencing supply and demand dynamics that are very, very favorable to the equity holders of the players in those industries. The market is not just AI and energy, as it seems to like to trade these days. And we think we've added a lot of high quality companies that the market is overlooking and focusing on at the moment. And as we move forward in time and fundamentals reign supreme, we've been doing this long enough that the share prices will ultimately reflect those values.
Well, great. Well, thank you so much for the insight there, Ben. And with that, we'll move over to returns. In the second quarter of 2026, the Vaughan Nelson small cap value strategy returned 10.69% gross, 10.42% net, up against the Russell 2000 value index at 17.19%. Brings a year-to-date return for the Vaughan Nelson small cap value strategy to 13.67% gross, 13.11% net, and 22.99% for the Russell 2000 value. For the past 1 year, 30.23% Vaughan Nelson small cap value gross, 28.96% net, and the Russell 2000 value is at 43.01%. With past 3 years, the Vaughan Nelson small cap value strategy is at 14.66 gross, 13.53 net, and the Russell 2000 value is at 18.73. Past 5 years, Vaughan Nelson small cap strategy 11.45% gross, 10.35% net, and 8.23% for the Russell 2000 value. And last, over the course of the past 10 years, the Vaughan Nelson small cap value strategies has returned 12.11% gross, 11% even net, and the Russell 2000 value is at 10.89%. And with that, that is a wrap on the second quarter. So thank you very much, Ben, and look forward to having you back soon.
Thanks, Dan.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.